Hi everyone, welcome to a new video here at Sublime Traders. I'm Logicalorange, and in this video we are going to take a look at on-chain metrics for Ethereum, because we all know there is this thing called the merge coming soon on the Ethereum blockchain, and it actually means a lot for the coin itself. Now, Vitalik Buterin, the founder of Ethereum, has already set not a very precise date, but we have a date. The date is the 15th of September this year, and it is basically tied to the terminal total difficulty, that is this number right here, and that is projected to be hit on the 15th of September. Now, the merge also means the end of proof of work, so mining, and the beginning of a new era, which is proof of stake. Now, in this video, we are going to take a look at some metrics for Bitcoin. So we have a comparison, and then we are going to move on to Ethereum, check out some metrics that can basically tell us where the price might be going this next month. All right, so let's start with BTC. I have on my left side, I have BTC futures, options, interest on perpetual contracts. So these are contracts that do not expire, and I'm taking them on all the exchanges. I'm only going to take a look at the last bar, and I'm going to note this number. So $8.3 billion worth of open interest in Bitcoin futures. On the right side, I have the BTC options open interest on all exchanges that offer options, because not all exchanges offer options. Now, options are a form of derivative trading, so trading in the future, and they have an expiry date. For those that do not use options yet, they cost a premium, and the premium is based on the length of the contract. So think of it like this: it would cost you a certain price to insure your car for a month, and it will cost you more to insure your car for a year. This is the same thing for options contracts. Contracts that are closer in expiry to the present date would cost cheaper, and contracts that are further away from the present date would cost more. Now, also a thing to note for Bitcoin is that we are now at 5.3, almost $5.35 billion in options of open interests on all exchanges. Now, these were just two metrics that I took for Bitcoin. I also have the price here just for reference, in order to compare with Ethereum later. So I'm going to jump from point to point pretty fast, so I don't bore you with these metrics. But right now I have on the left side ETH futures open interest on all exchanges. We can compare them. So 8.5 billion compared to 8.3 billion on Bitcoin. We have slightly more open interest on futures contracts on Ethereum. And on the right side, I have options open interest for all exchanges that offer options for Ethereum. And the last candle is now sitting at $164 billion. And this is extremely big compared to the Bitcoin options open interest, which is sitting at 5.3. So we have already established that there is more interest in options expiring next month or even further for Ethereum than there is for Bitcoin. Now, this is extremely simple. Bitcoin next month will not have any improvement. It will still be Bitcoin, and it will still have its price naturally going up or down. However, Ethereum will have a extremely important merge, so structural change, moving from POW to POS, and this is predicted by traders through this metric. So through options, traders predict that the price will move extremely high, even double based on some metrics. Now, there is a metric that is basically the ratio between the longs and the shorts on options. Now, longs on options are called calls, and shorts on the options derivatives are called puts. So we have a lot of puts for options expiring in September 15th that are priced, have a strike price at around 4K. So 4K Ethereum, this would mean 100% increase in the price from the present price right now. And we have very little puts in these contracts. Now all these calls that are being taken right now by traders can also be hedged positions for positions they would have in spot, but we will see a bit later that this is not really the case right now. People are just betting that the Ethereum price will go higher up until the merge, so they are just positioning themselves right now with small amounts, incremented amounts, even DCAing in, and options, buying options, multiple options in also small amounts, predicting that the price will go up until the merge, and then people will probably start positioning themselves with put options and shorts positions on futures contracts, predicting that the price would go down after the merge. So we have a buy the rumor, sell the news kind of situation. We will obviously have a lot of media posting news with the merge, going closer to the actual event. And the rumors right now are that the price of Ethereum will go up until the merge. So people are buying the rumor, and they will probably also sell the news. It has already happened before with other coins and other news. Now, let's take a look at the BTC open interest put to call ratio between ETH and BTC. Now we can see that this line is the put to call ratio for BTC. The blue line is the put to call ratio for Ethereum. Now we can see that Ethereum is slightly moving closer to the BTC put to call ratio right now. So the open interest, as we have already established on options, is increasing and will certainly depass that of Bitcoin on this graph. Another metric that I want to take a look at with you guys, which is extremely important, is the futures perpetual funding rate for Ethereum on all exchanges. Now, many people take a look at the funding rates but don't really understand what they are and why they matter. Now, I'm going to refresh your memory by explaining that funding rates is a system that is used by exchanges on futures markets in order to automatically rebalance those markets. So, for example, if we have an over-leveraged situation on the long side for any given coin, those people that are holding long positions and that are leveraged on that exchange will pay a fee to people that are on the opposite side of the trade. So, for example, too many longs in a futures market would cause the system to automatically calculate and establish a fee that will be paid to the shorts in that same market. In this case, the market will be slightly rebalanced by those fees. So people are less and less enticed to take longs because the fees are higher, and people will also be enticed to take shorts because they have a fee that will be paid to them if they are on the other side of the trade. Now, note that on this chart, the higher we go away from the mean area, which is the 0 point, the higher the funding rates, which is logical. But also, what happens when we pass a certain level on funding rates is that market makers start to push more on their market making algorithms in order to position themselves on the opposite side so they can get paid by funding fees. So, for example, right now we are in the negatives. This would mean that shorts pay longs, right? So we are pretty far away from the midpoint right here, and this would mean that market makers have already started or will potentially start soon to position themselves in order to take advantage of this funding strategy. So this is also an important thing to note. Market makers are real. These are not some fairy tales. They just watch the markets and try to take profit there where it is possible. And I'm going to end this video with the ETH exchange net position change on all exchanges. Now, net position change is just a fancy word to say inflow and outflow out of exchanges. Now we can see that this is highly decorrelated with the billions that we saw on the open interest for on all exchanges. So we know that people are extremely interested in trading futures and options, but the interest in spot is not that high. So we can see that the number of traders that are actually investing or betting in Ethereum through spot holding, so actually holding the asset, is not that high. However, if we look at this chart, we can see that on every outflow we have had more over less or less of a rally, because this is also like a supply and demand chart. We can consider it like a supply and demand. The more supply, the more dangerous it gets for long positions. The less supply, the more interesting it gets for long positions, because we are on spot, we are only thinking about longs. So right now we are in a fairly neutral area, but we are also in what can be considered as a buy zone, because we don't have too much supply yet. So neutral zone for spot. Now this is another layer that we can add to this whole analysis right here. My main focus on this video was around options interest, because it is a really good tool to predict the future, because more people are betting on it to go higher on the option side. So yeah, this is all for today, guys. Thank you for watching. If you have questions, don't hesitate to write in the comments in this video. And if you like the video, please like and subscribe, and see you in the next one.